The headlines are endless. Fears of a consumer collapse are spreading.
Came in at a multi-year, even an all-time low, which just shows a really bad outlook among consumers.
MarketBeat's Thomas Hughes dives into 4 retail stocks that are all crashing right now.
Has had a pretty significant sell-off over the last few quarters.
But he says some of this downtrend could be opportunity for retail investors.
Cash flow is still healthy, balance sheet is still healthy, capital return is still healthy, including share buybacks.
Plus, he'll talk about 2 retail stocks that are still climbing despite the consumer downtrend. Let's dive in. Thomas, so great to have you back on the show, this time talking about that consumer collapse that's been in the headlines for weeks now. Let's talk a little bit about some of the statistics that have led to some of this fear and those consumer fears that we have out there right now.
The biggest reason was the University of Michigan consumer sentiment figures, which were revised slightly higher, but still came in at a multi-year, even an all-time low, which just shows a really bad outlook among consumers. And certainly that is concerning because poor consumer sentiment will be reflected in consumer spending habits. But other than consumer sentiment being low, there's not really any indication of retail or consumer spending faltering. So it's a tricky statistic to follow. It certainly has been generating plenty of headlines, but it's not one that I am going to start, repositioning just because of this one data point.
Yeah, we're going to cover a list of 6 different retailers today. We'll get into that in a little bit that are all kind of in different situations. Some really making major headlines of how much of a collapse their stock has seen in the last couple of weeks. But let's talk first a little bit about some of the other statistics out there in the economy. Where is the CPI at right now? We can also talk rate cuts a little bit. What are some of those other statistics out there that could be influencing consumer sentiment?
Well, right. So the CPI data was pretty decent. I mean, it didn't cool down a lot. We haven't seen the PCE numbers for 2 months, but we'll get an update next week when we have those delayed releases released. But right now, inflation is kind of tame, and the other data is kind of showing that labor markets are still resilient. So as far as Fed rate cuts go, we're kind of threading this needle between inflation and labor. And right now, they're both kind of moving around. It's uncertain, but we think the Fed is going to be lowering rates. And it's just a matter of how quickly they do it. The market had been pricing in a pretty aggressive pace, but that pace has kind of cooled down in the last few weeks. A few weeks ago, we were looking at 2 more cuts, probably 50 basis points worth of cuts in December. But now we're down to maybe about a 50-50 chance for just 1 cut in December. They're not going to cut rates as much as we might have thought. But on the other hand, that's because economic data is still pretty resilient. So, we might not get that boost from lower rates that we thought we were going to get. But at the same time, the economy is still okay, still supporting the bullish outlook that we had before. So it's just a matter of which story is going to be most prominent in investors' mind on a day-to-day basis. And with the headlines, the way they roll, one day the market's going to be scared about inflation and interest rates, and the next day they're going to be happy about economic resilience and the outlook for earnings. So to me, this is just more bricks on the wall of worry.
There's a lot of worry out there, that is for sure. And it especially can be seen in some of the stock charts that we are going to look at in just a minute. We are going to go through 6 different stocks in the retail sector right now, kind of all in different positions. A reminder, we've launched Bridget's Buys. And so as we go through this list today, I'm going to be paying attention, looking at the charts right along with you. And I'll pick my favorite from this list to add to Bridget's Buys, and we'll track it over time to see how well it does. So let's dive right into the list of the 6 different stocks you have to talk about today, starting off with the 4 stocks that are really down right now.
Actually, the first retailer to report this cycle was Home Depot, and it kind of set a sour tone for the reporting season, for the reporting cycle. But when you look in the report, Home Depot is down because of one-offs and company-specific details more than general retail conditions. So the stock price had been under pressure before the release came out, and that is just because of general market sentiment was kind of souring. But then Home Depot put out a tepid report, and they blamed the lack of storms. It was a pretty big storm season, but not many storms hit the American mainland. So storm damage is a big driver for Home Depot's business. That played into their miss and their weak guidance, and that led their stock price to decline. But conversely, Lowe's did not report the same weaknesses, and that stock price moved higher. So again, with Home Depot, this really is company-specific and market-specific reasons for it to fall more so than general retail conditions.
Yeah, looking at the Home Depot chart, we're not talking about a massive collapse, but for a large company to see not quite a 15% drop in the last 3 months, I think some investors are out there wondering, is this a buy the dip opportunity on a stock that's been around for a long time, has been more of that like solid blue chip company? What are your thoughts on whether this is a buy the dip opportunity or not?
I think it would be for Home Depot and for the other stocks in general, because there is a lot of market sentiment involved with the sell-off. Long-term outlook is still pretty good, with rates expected to fall. Even if they fall only a little bit next year, we still see some economic headwinds diminishing, potential for tailwinds to build. And within all of this, Home Depot's cash flow is still healthy, balance sheet is still healthy, capital return is still healthy, including share buybacks, which helps to provide investors with leverage over time. So Home Depot stock could be under pressure for the foreseeable future, but as long as we don't break some critical support levels, I would expect it to move sideways and eventually begin recovering next year.
Yeah, that part about not breaking critical support level is key right now. I know some investors out there might be concerned about the potential for the market sliding even further. If that's you and you're looking for some other defensive names to play right now, check out this new premium article with a list of 5 defensive consumer stocks to watch if the market keeps slipping. You can scan the QR code or click the link in the description to get that list right now. Again, these are not buy recommendations. This is just a list of stock ideas where you can do your own research and see if this is the kind of investment you're looking for in this current market. All right, let's move on to the next stock. We have a lot to cover today. This
Right,
is the other one that's been making the biggest headlines. That
right.
is Target.
Target, again, Target, this is company specific issues and not general retail conditions. Target lost relevancy. It lost its core market. It's been in contraction. This last report was kind of in line with expectations, but that was for a minus 1.5% decline. Guidance is for additional declines. So even with the strength that it showed, which was some growth in digital, it had good cash flow, the dividend, the repurchases are still safe, but the company is still in decline compared to the rest of the retail market, which is expanding.
Yeah, interesting to see. This is not the first kind of lower report that we've seen for Target, right? Let's talk about the history of this one a little bit and how far this company's been seeing a decline.
Well, right, Target's been in decline for quite some time because with its loss of relevancy, its loss of chic within the marketplace, it's been losing share and it's continuing to lose share. And what we see in the results from its competitors, such as Walmart and TJX companies, is they're gaining that share. So, as I said in my article, Target's losses are its competitors' gains. For investors, Target does present an interesting opportunity because it is trading in deep value levels. It's got a really high yield. I think it's over 5% right now. It's buying back shares, which is good, and they look safe and reliable. But until it can return to growth and start reestablishing its position as a retail player, there's a lot of risk and lower share prices.
And this one's an interesting story to me, especially among probably my demographic is more the target for Target. Lots of people are big Target fans out there. So is there a chance for that rebound to happen? Is this more of a company-wide issue? Is this a branding issue? It's curious to see what it would take to turn this stock around.
I think it's going to take some time. It might take some innovative marketing and rebranding because their branding issues are part of the problem. Now, you said it yourself, you're one of their target demographics. And with macroeconomic conditions the way that they are, the young mothers are the ones who are going to be looking for bargains the most, and they're going to be going to Walmart to get it probably. Now, one thing that came out in Target's release is that it's going to start leaning more into like offering values and deals and things like that. And so the question is Target going to be able to build on that and regain share from Walmart, or is Walmart just going to keep sucking its traffic away?
Yeah, an interesting question. And when I think about adding this to Bridget's buys, I like Target as a company. Again, their marketing has worked on me. I definitely shop there, but I don't know if it'll be enough to add it to Bridget's buys. We'll see at the end of the video which one I'm actually going to add. Let's get through
Right.
the rest of your list. Which is the next one?
All right. So the next stocks we're looking at are BJ's Wholesale Club and Williams-Sonoma. Now, these are kind of on two different ends of the spectrum. BJ's is a membership club. They're looking at values and cost savings for its clientele. Williams-Sonoma is more of a premium brand to a higher end market. Both of their stock prices have pulled back or have shown some weakness in the wake of their reports, but ultimately, these are buying opportunities. BJ's in particular has had a pretty significant sell-off over the last few quarters. But now it's bottoming, showing a nice, pretty solid bottom, I think, a head and shoulders bottom that I believe will lead into a full market reversal. We could possibly see this stock rebound by 30% or more over the next year because it's growing, it's outperforming, it's raising guidance, its cash flow is good, its repurchases are good, reduced the share count by more than 1% over the last quarter. So all really good news for investors, provide lots of incentives to buy. And within that, very robust institutional trends. Institutions own almost 100% of BJ's stock. They've been buying on balance. Buying activity accelerated in Q4 while selling decelerated, which just shows that tailwind is strengthening. So what I'm expecting now to see with this market is for the analysts to begin reaffirming or even lifting their price targets, kind of reverse the sentiment trend that was in place earlier this year where they were reducing targets. When they start lifting targets, that'll really be a catalyst for this market and really get it into motion.
Yeah, we haven't talked about analyst price targets yet much in this video, talking about these stocks. There still seems to be a pretty high consensus price target for this one compared to where the stock is trading right now. Do you think we could see some other price target reductions coming? I know there's a pretty recent one that moved all the way down to 85.
So all of those were before the release, all part of that market sentiment, the fears of weakness that were not reflected in the results. So what I would expect is, at worst, we'll see reaffirmed targets, and that'll just kind of reaffirm the consensus, which is for a 30% upside. At best, we'll see the targets start being lifted again. And in that case, I see this market moving into the high-end range, exceeding that 30% target, setting new highs, probably by mid-year next year.
All right, an interesting company to look at. I like the warehouse style. I'm a big Costco fan. We don't have any of these in my market yet, so I've not been there, but I like the concept as usual. So that's an interesting one to consider. You already mentioned the next one, Williams-Sonoma. I know this is a personal experience with you. You used to be a chef before you got into the stock market, right, Thomas?
Right. I love the brand because of the quality, the durability of it. But these results prove this company, its clientele, its business are very strong. So there has been some pullback with spending, but they've been able to sustain growth. They've been able to maintain margins with full price selling environment. They've been able to still provide value to their clients. Robust margins. This last quarter, margins came in above target at the high end of their long-term forecast range. They ended up raising their margin guidance for the year, which all just plays into their dividend and share repurchases. This company is repurchasing at a very aggressive rate, reducing its share count by more than 1% each quarter, doing a very good job at that, creating lots and lots of leverage for investors, definitely setting itself up for some upside. And I think in this chart, right after the release, showing some weakness, but then it hit this critical support level and it's already rebounding. So in the news stream, I see that TD Cowen has maintained their buy rating, reflecting their confidence and their price target, which is leading this market higher. Pretty good amount of confidence in the analysts for their consensus target, which right now is forecasting only a 10% upside, but that high-end range puts us near recent highs, on track for hitting new all-time highs, but definitely above the cluster of moving averages, which to me is a critical pivot point. Once we get back above these critical moving averages, this cluster of moving averages, we'll see the market start working more in sync to where short-term, long-term, and mid-term investors are all kind of buying at the same time, and that'll help get this market moving higher.
Yeah, I've got a couple of follow-up questions on this one. And one is that when we talk to retail investors out there, a lot of people who watch our channel are looking for the really high growth stories. We often talk about AI and tech stocks that are seeing huge run-ups. These retail stocks, this one included, we're only talking about a potential, like you said, 10% upside. Is this something that retail investors should still be interested in, even if it's not those huge growth stories?
Retail stocks aren't going to be wicked hot growth stories. You're not going to see wicked hot share price increases, but these really core critical ones are usually buy and hold quality. They're going to trade in some big ranges sometimes, so you got to be careful of your entry and your exit points. But the real story with them is cash flow and capital returns. So if you buy them at the low ends of their ranges and their channels so that you dollar cost average in, and you keep a good, nice, low cost basis, then you reap the benefits of dividends and share buybacks. And over time, their stock prices will trend higher.
My other question with Williams-Sonoma is just thinking about the timing. It is Black Friday week, one of the biggest shopping weeks of the year right now. And Williams-Sonoma seems like it could really benefit from that year-end holiday shopping, right?
Absolutely. I think that Black Friday and Cyber Monday could be a catalyst for the entire group. Target had the weakest digital sales at plus 10%, I think, but most of the others grew digital sales by about 30%. So I think that we could see a really big boost for all of them based on Black Friday and Cyber Monday sales.
Yeah, and that was something that came out in earnings season, correct? That there was some really strong and promising numbers, at least in the digital sales area.
Oh, absolutely.
All right, another interesting point to think about when you look at retail stocks. Okay, so both of these, both BJ's and Williams-Sonoma, could be potentials for Bridget's buys. But I want to get to these last two stocks you have for us. These are retail stocks that are actually in the green right now. They're not on a decline of any kind. What's that first positive retail story?
Well, the first one is Walmart. Walmart is the world's largest retailer. It's the world's largest employer. It's growing at an industry leading pace. It outperformed. It grew its earnings, supported by digital up 30%, robust cash flow, dividends, and share repurchases. Within all of this, it also raised its guidance, which is a boost for market and analyst sentiment. Analysts are raising their price targets, and the stock is responding favorably. And we've got Walmart showing a trend following signal with a nice solid move up from its long-term moving average. Right now it's wrestling with a little bit of resistance at the all-time highs, but the consensus and the analyst trends are leading us to new highs, which I would expect to be set before the end of the year.
One name we're not talking about on this retail list today is Amazon, which we know has been such a huge retailer. They saw a really big boost in sales, I believe, over the summer period during their Prime days. Is Walmart becoming a better competitor with Amazon? I feel like in the retail discussion, it's no longer Walmart versus Target. It's more Walmart versus Amazon.
I think that's the case, and a lot of that has to do with the digital presence. Walmart's website is getting bigger and better all the time, and obviously seen in its digital sales for the quarter.
One other quick question with Walmart is we're seeing some positive trends in this stock. Is this a time that consumers would want to get into the Walmart stock when it's up like this, when it is near those all-time highs? Talking about timing these retail stocks being important, is now a time to be looking at Walmart?
Now is a good time to look at Walmart. And we're looking at this company to continue growing, continue producing its cash flow, continue buying back shares and paying dividends. As I said before, we're looking for some tailwinds to possibly form next year to help, boost the growth outlook. All of that together tells me the stock is going to continue trending higher. Right now, it looks like we're going to see new highs set pretty soon. In that scenario, we will be breaking out of a consolidation range that could put $25 under the stock price. We could see Walmart at, 135, 140 pretty soon. Next year, 18 months.
That's a decent upside for Walmart. Again, these are just a look at kind of the story of these stocks. We're not giving any stock recommendations here on MarketBeat. We are just going through the stock story, looking at earnings and looking at what analysts are saying about these companies. So before you do any buying of stocks yourself, you should always look up and do your own research on where these stocks are at. So I'm doing that too. I've looked at some of these stock charts before I decide which one to add to Bridget's buy list. That's a watch list of mine. I've got one more stock to cover with Thomas here before we get to which one is going to make it on that list. So Thomas, let's get to the last company that's a retail stock that's still doing really well, even in this kind of down consumer sentiment.
Well, right, that's the TJX company. And this company is doing very, very well. The retail environment right now is perfect for TJX companies. They're an off-price retailer. So what we have going on is macroeconomic conditions have caused consumer habits to shift. They're not buying their name brand products from name brand stores or from the manufacturer necessarily. So we're seeing that impact sales for some companies who are then turning over and selling all their unsold inventory to people like TJ Maxx, who are able to offer the same brands, the same products at quality values for their customers, growing at an industry-leading pace, widening margins, strong cash flow, strong repurchase activity, strong dividends, improved guidance, strengthens the entire outlook. Stock prices up almost 4% for the week, setting new highs, extending the uptrend. Right now, it looks to me like the uptrend is gaining momentum. Analysts are raising targets, leading it higher. So, to me, this is the absolute best in breed retail stock to own right now.
Well, let's talk a little bit about what this says about the economy when you see this kind of more bargain retailer, discount retailer seeing such an increase right now in business. Is it a branding thing? Is it a reflection of where the economy and consumers are at right now?
I think it's evidence of what I was saying in the first part of the segment, which is that there are consumer headwinds that are impacting some results for some retailers, but ultimately see retail is still strong. Consumers are still resilient. They've got plenty of money to spend. They're just being price conscious and they're focusing their dollars where they see the best values.
All right. So the same question for retail investors out there as we're looking at these retail stocks and see the story of TJ Maxx doing so well right now. Is now a time to get in, or is this stock too high for retail investors to look at right now?
It seems to be extended from its moving averages, so I would be hesitant to chase the price. I would wait for it to pull back some, but with the uptrend in place, I would say that TJX would be a buy on a pullback.
All right. So then today, right now, TJ Maxx is probably not going to make it onto Bridget's buys, even though I love this company. Not the right timing for this one. I think out of all of this list today, we've covered a lot of different stocks. I think I'm going to go with BJ's just because of where it is right now, lower priced at the moment, but I think the concept has potential to do really well. I know we talked about BJ's earlier on in the year as a company that had some really strong potential, was doing some aggressive growth, trying to add stores and locations. So an interesting concept. This one is maybe the hardest one of the stocks we've covered so far. Harder to choose which one, but I'm going to go with that one, adding it to Bridget's buys right now. You can scan the QR code or click a link. We've got that right in the description of this video. If you want to check out Bridget's buys list, it's a watch list, just paper trading, tracking to see how well these stocks do over time. There's only a couple of names on there right now. We just started it this week, but I'll be adding a lot of names to it as we do videos every week. So you can track all of them, and kind of a good way to track the progress of the stocks we talk about on this channel. What do you think, Thomas? Was that a good pick for this one?
Yeah, I think it's a pretty good pick.
All right. Sounds good. Thomas, thank you so much for your time today. Thank you, everyone, for watching. As always, happy investing.